There is a mechanism running inside the stock market right now that forces index funds to buy specific stocks, whether they want to or not. Not because of earnings or news, but because of math. And most retail investors have no idea it is happening. The mechanism is called the Russell reconstitution. And once you understand how it works, you will never look at index funds the same way again. Every year, FTSE Russell rewrites the membership lists of the Russell 1000, 2000, and 3000 indexes based on market capitalization. They pick a rank day, calculate which companies belong in which index, and then on a single Friday, every fund that tracks those indexes has to buy or sell to match the new list, regardless of what any human investor thinks those stocks are worth. Here's the number that makes this real. $2 trillion in investor assets is benchmarked to Russell indexes. The 2025 reconstitutions saw $217 billion trade in the final minutes of the session with 5 billion shares transacted on the NASDAQ, closing cross alone executed in under 1 second. Now, here is the part that hits closer to home than most people realize. If you own IWM or VTWO or any Russell tracking ETF, or if you have a 401k with a small cap sleeve or a target date fund, your money is about to flow into specific tickers on Monday morning, whether you do anything or not. The reconstitution is not some exotic hedge fund strategy. It is already inside your retirement account. 2026 is actually unusual because this is the first year FTSE Russell moved from an annual to a semi-annual reconstitution schedule, happening in June and again in December. The list is locked and 237 companies are being added to the Russell 2000. Let me show you 4 specific companies sitting in the middle of this event. The first is BOB's Discount Furniture, which went public in February at $17 a share, hit $23, and then got crushed to under $10 before recovering to around $13. What makes this one interesting is the short interest. 5 million shares sold short, representing 3% of the available float. That is a lot of traders betting the stock keeps going down. Now you are about to have index funds forced to buy it on a fixed deadline. High short interest plus forced buying pressure is the mechanical setup for a short squeeze. The second and most compelling name is Elmet Group. They manufacture precision-engineered components for aerospace, defense, semiconductors, and energy, using refractory materials like tungsten and molybdenum, plus microwave components for radar and missile tracking. This is a reshoring story tied directly to critical defense supply chains. Elmet went public in late April, raising $125 million. Market cap around $565 million. The reason this one is the most interesting is that the underlying business is in exactly the sectors getting the most institutional attention, and it is small enough that the forced buying from reconstitution represents a more meaningful percentage of its float than it would for a larger company. The third is Once Upon a Farm, the organic baby food company. Revenue grew 44% in the first quarter of 2026, and they raised full-year guidance. Here's the thing. The business is performing even though the stock is down about 27% from its IPO. The fourth is Yesway, the convenience store chain that owns Allsups. $67 billion in 2025 with earnings up 131%. Now let me run the actual math on forced buying. The Russell 2000 total market cap is roughly 3. IWM, the iShares Russell 2000 ETF, holds about $81 billion in net assets. To estimate forced buying from IWM alone, divide the stock's market cap by 3. 5 trillion, and multiply by 81 billion. At current market caps, that means roughly $40 million of forced buying for Bob's from IWM alone. About 33 million for Yesway. About 15 million for Once Upon a Farm. And roughly 13 million for Elmet. Those numbers are a floor, not a ceiling. IWM is just one ETF. There are many more funds and separate accounts tracking the same index. Here is the honest caveat. This effect has shrunk over time, as traders have gotten better at front-running it. Some of the move may already be priced in. And historically, stocks sometimes sell off after the event, when the forced buying ends and the front-runners exit. The point of this video is not to tell you what to buy. It is to give you the mechanism